Welcome along. We're doing a deep dive today, specifically designed for you if you're a business undergraduate just starting out in finance.
That's right.
Think of this as the big picture view, your first flight briefing, maybe. We're looking at the financial system from 30,000 feet, drawing on typical intro finance materials.
Yeah, the goal really is just to give you a clear map of the territory before we get into the weeds later on. How does this whole world basically operate?
And the word finance itself is kind of interesting, isn't it, from the French fin?
Meaning end or conclusion, which sort of highlights how today's financial decisions, well, they shape what happens down the road.
Right, and at its absolute core, what are we talking about?
It's really about channeling capital, moving money from people who have extra savers to people who need it for something productive borrowers. That's the fundamental job.
Okay, but it wasn't always like stock markets and banks, obviously. How did it start?
Well, yeah, way back, it evolved from really simple reciprocal relationships. I help you now, you help me later. Basic stuff in early societies.
Then agriculture changes things.
Massively. Around 9000 BCE, agriculture brings surplus, populations grow, trade expands, and suddenly you need something more sophisticated.
Because of that timing issue.
Exactly. That's a great point. Agriculture creates this fundamental problem. Farmers need stuff like seeds before they have anything to sell from the harvest.
So they need resources now, but can only pay later.
Precisely. And finance, even in early forms, solved this. How? Through legally enforceable contracts. Basically, an agreement to exchange value over time. Seeds today, payment plus some interest after the harvest.
And the real foundations for sort of modern finance start appearing where?
Mesopotamia, around 3000 BCE. It wasn't just finance in isolation, though. It developed alongside advances in math, bookkeeping, laws, even standardized timekeeping. You needed all those pieces.
Right, the essential toolkit.
And as societies got more complex, so did the finance, which leads us to what finance actually does in our modern economy. There are really two main roles we should focus on.
Okay, first one.
Channeling that capital, like we said. Savers to borrowers. This is huge for economic growth, for innovation, businesses getting loans to expand, that kind of thing.
Got it. And the second?
Helping people and organizations prepare for the future, financially speaking.
So like saving for retirement, investing.
Exactly. And managing risk, too. It's about building financial security for the long haul.
Let's make that a bit more concrete.
Yeah.
Access to credit, for example. That's finance in action, right?
Absolutely. It lets individuals buy homes, cars, pay for education, big-ticket items you likely couldn't afford up front.
And for the economy as a whole.
That flow of capital funds, businesses, infrastructure projects, that means jobs, innovation, hopefully better living standards. It also, importantly, can level the playing field a bit.
How so?
Well, if you're an entrepreneur with a great idea but no personal fortune, finance can give you a shot by providing the capital you need to get started.
Okay, that sounds pretty positive. But there are downsides, potential problems within the system too.
Oh, definitely. We have to acknowledge the risks. Things like financial fraud, Ponzi schemes, cooking the books.
Predatory lending.
Predatory lending, yeah. Insider trading, manipulating markets, money laundering. The list is, unfortunately, quite long.
Which means trust is just fundamentally critical.
It's everything. If people don't trust the system, it breaks all down.
So how do we build and maintain that trust? What are the tools?
Well, there are several layers. Regulation is a big one. Governments set rules, standards, penalties for breaking them.
And then someone has to watch over it.
Right. That's oversight. Regulatory agencies monitor what's happening, investigate problems, and enforce the rules. Think of them as the referees.
And education, does that play a role?
It does. Educating people involved in finance professionals and consumers about ethics and best practices helps foster better behavior.
Okay. In the U.S., who are the main regulatory players we should know about?
Well, there are quite a few, but some key ones. The SEC, the Securities and Exchange Commission, they oversee markets for stocks and bonds, securities trading.
And the Fed. We hear that name a lot.
The Federal Reserve, yeah. Hugely important. They oversee the banking system, but also manage monetary policy, interest rates, money supply, that kind of thing.
There's also one focused on consumers, right?
The CFPB, Consumer Financial Protection Bureau, they look after things like mortgages, credit cards, making sure consumers are treated fairly.
And one more.
The CFTC, Commodity Futures Trading Commission. They regulate futures and options markets. Think commodities like oil or agricultural products, but also financial futures.
Okay, so we have the why, the roles of finance, and the who, the regulators. Now, let's get back to that core function. Moving the money. How does it actually happen?
Right, the mechanics. So funds flow from surplus units, typically households saving money, to deficit units, often businesses needing investment capital, or governments borrowing.
And this flow can happen in two main ways.
Yeah, broadly speaking, either directly through financial markets or indirectly using financial intermediaries.
Let's take markets first. What are we talking about there?
These are just venues where financial instruments, securities are traded. You've got stock markets for equity or shares.
Ownership in companies.
Exactly. Then debt markets for bonds, which are basically loans. There are also markets for commodities, derivatives, those complex instruments whose value depends on something else, and currencies.
Okay, so that's direct. What about the indirect route? Through intermediaries.
Right. These are institutions that stand in the middle. They connect savers and borrowers, making the whole process smoother. They help overcome problems like finding someone to borrow from or lend to, and the fact that one side might know more than the other.
Examples.
Commercial banks are the classic example. They take deposits and make loans. Investment banks help companies raise funds by issuing stocks or bonds.
What about mutual funds?
They're investment managers. They pool money from lots of savers and invest it. Brokers help people execute trades. Insurance companies manage risk.
And some big firms do lots of these things.
Yeah, giants like Bank of America or JP Morgan Chase offer a whole suite of these services.
And what motivates the savers and borrowers here?
Incentives, basically. Savers put their capital out there expecting a return. That return compensates them for, one, not having the money available to use now, the time value of money, and two, the risk that they might not get it back.
And the borrowers? The users of capital.
They need the funds to pursue opportunities, build a factory, develop a new product opportunities that the savers might not have direct access to. It encourages specialization.
So businesses raise these funds by issuing securities.
Exactly. Securities are just tradable financial assets representing some kind of contract. The two main types you'll encounter first are debt and equity.
Debt is borrowing, like a bond.
Yeah.
You owe interest and principal.
Right. And equity is selling ownership. Stocks or shares. You give up a piece of the company.
Now, there's a difference between where new securities are sold and where existing ones trade.
Yes, crucial distinction. The primary market is where new securities are issued and sold for the first time. Think of a company doing an IPO, initial public offering, selling stock to the public. The money goes to the company.
And investment banks often help with that.
Yes, they often underwrite the deal, meaning they handle the marketing and distribution, sometimes guaranteeing the sale price.
Okay, so that's primary. What's the secondary market then?
That's where investors trade those already issued securities among themselves. If you go online and buy shares of, say, Apple, you're almost certainly doing it in the secondary market.
And the money in that trade doesn't go to Apple.
Nope. It goes to the investor who sold you the shares. The New York Stock Exchange, NASDAQ, those are primarily secondary markets.
Got it. Okay, let's shift gears slightly and talk about corporations. Why are they so central to finance?
Well, they're a dominant form of business organization, especially for large enterprises that need a lot of outside funding. They have some key features that make them suitable for that.
Like?
One is joint stock ownership. Lots of people can own shares, and they can buy and sell those shares without disrupting the company's existence.
And they're legally distinct entities.
Yes. Corporate personhood. The corporation itself is a legal entity. It can own property, sign contracts, sue, be sued. This also leads to that double taxation issue. The corporation pays taxes, and then shareholders pay taxes on dividends.
But shareholders also get limited liability.
Crucially, yes. Your risk as a shareholder is generally limited to the amount you invested in the stock. Your personal assets are protected if the company gets into trouble.
Now, with potentially thousands of owners, how are these companies actually run? That brings us to corporate governance.
Exactly. Corporate governance is the whole system, the rules, practices, processes for directing and controlling a company, because you have the separation of ownership, shareholders, and management executives.
You need a way to make sure management acts in the owner's interests.
Precisely. That's where the board of directors comes in. They're elected by the shareholders to represent them, set strategy, and oversee the management team.
And the board hires the executives, like the CEO.
Usually, yes. The executives, led by the CEO, handle the day-to-day running of the company, implementing the board's strategy. Other key roles are the CFO, Chief Financial Officer, and CRO, Chief Operating Officer.
But this separation can cause problems, conflicts of interest.
It certainly can. What's best for the CEO might not always be what's best for the shareholders. Maybe the CEO wants a bigger empire, even if it's not the most profitable move. Good governance tries to align those interests, maybe through stock options or performance bonuses tied to share price.
How can shareholders actually influence things if they don't like what management's doing?
They have several tools. Voting rights on major issues, like electing directors. They can submit shareholder proposals. Sometimes large investors engage directly with management. That's shareholder activism.
And in more extreme cases.
Proxy fights, trying to get their own slate of directors elected. And of course, they can always vote with their feet and sell their shares, which can depress the stock price and put pressure on management.
Are there structures that can weaken governance, make management less accountable?
Yes, things like super voting stock, where some shares get way more votes than others, often held by founders or insiders, or CEO duality, where the CEO is also the chairman of the board. That reduces the board's independence.
Okay, stepping back a bit, what's the fundamental purpose of a corporation? Is there agreement on that?
Not entirely. It's actually a pretty big debate. The traditional view, especially in the U.S. for a long time, has been shareholder value maximization.
Meaning the main goal is to make the stock price go up.
Essentially, yes. Maximize wealth for the owners, the shareholders. Milton Friedman was a big proponent of this idea. It's clear, measurable, but it gets criticized.
For potentially ignoring other impacts.
Right. Critics say focusing only on shareholders can harm employees, communities, the environment. This leads to the idea of corporate social responsibility, or CSR.
Which says companies should think about all stakeholders.
Exactly. Employees, customers, suppliers, the community, the environment. Everyone affected by the company's actions, sometimes called stakeholder value.
Is this gaining traction?
It seems to be. You see things like ISO 26000 standards for social responsibility, B Corp certifications for companies meeting certain social and environmental standards. Even the Business Roundtable, a group of top U.S. CEOs, revised their statement a few years ago to emphasize commitment to all stakeholders, not just shareholders.
But measuring stakeholder value seems harder than just looking at a share price.
It is definitely more complex. How do you balance potentially competing interests? It's a challenge.
And this ties into ESG investing, too.
Very much so. Environmental, social, and governance investing. Investors are increasingly considering these factors, putting money into companies they see as responsible. There are different approaches, excluding certain industries, focusing on themes like clean energy or picking the best in class within each sector.
But there are questions around that, too, like greenwashing.
Yes. Concerns about whether companies are genuinely committed or just saying the right things. And the lack of standardized definitions for ESG makes comparisons difficult. It's an evolving area.
Wow, okay. So that's quite a tour, from ancient Mesopotamia to ESG investing.
It really is a broad landscape. We've covered the origins, the key functions finance performs in the economy, the rules of the road with regulation.
How money actually moves through markets and intermediaries, and the whole setup of corporations and how they're governed.
Yeah, a solid 30,000-foot view, hopefully. It's worth thinking about how that basic timing problem in farming thousands of years ago connects to the complex derivatives traded today.
Or considering the different incentives pulling savers and borrowers into this system.
And definitely reflect on that ongoing debate about what a corporation is truly for. Is it just about shareholder returns or something broader?
Absolutely. This overview is really just laying the foundation for your finance journey. We'll be diving much deeper into specific areas like debt, equity, analysis, and investing strategies in future deep dives.
So as you digest all this, think about what grabbed your attention most. What questions popped into your head?
Yeah, what areas do you want to understand better? Keep those questions handy as you continue exploring the world of finance.